Investors, I want to officially welcome you to the second half of 2023, but also take this time to warn you that it may not be as green or as profitable as we would have hoped, especially with the recent news of the latest employment numbers or the newest of insights from the Federal Reserve's latest release of the FOMC meeting minutes. But more on all of that to come. If you're new here, I'm Ari, a dividend investor here on YouTube, looking to share all the economic insights that you need to remain aware of and brand new dividend stock ideas that will help you drive more profits regardless of the economic climate. Now, as for today, aside from discussing all these new economic insights, I have 5 discounted dividend stocks worth your attention right now. So with that, let's dive right in. Now, before I get into all these economic insights and share these dividend stock ideas with you, let me give you a quick update on my personal account. It's currently sitting at $121,159.09, which is down nominally from weeks prior after some of the latest negative news headlines out of the Federal Reserve and the latest employment report, which I want to talk briefly about so you know at least on a macro level what in the world is even going on and how to prepare accordingly. So as we know, just a few weeks ago, the Federal Reserve hiked interest rates, which shook up the entire market. But what was more unexpected was actually the hawkishness out of the Federal Reserve, as Powell shared that more hikes are coming our way. And now, this past week, the latest FOMC meeting minutes made it very clear when they were released in the midst of a shortened week that there is going to be a ton more to worry about in terms of interest rate hikes because the Federal Reserve is remaining very hawkish.
Almost all saw future rate hikes as being appropriate, and some even wanted to hike by 25 basis points at the June meeting. We don't know how many some is. We know it's less than many, and it's more than a few. The reason they wanted to hike was because they saw the labor market as tight, and they saw few clear signs that inflation was returning to the 2% target. Most said, however, the Fed would benefit from taking a little more time, dealing with the high levels of uncertainty that were out there. Those uncertainties included the lagged effects of monetary policy, as well as tighter credit conditions from the banks and what kind of effect that would have on the economy. Almost all saw inflation risks to the upside.
This made the market waver out of fear, and on Friday we had yet another employment report showing the sheer strength of our labor market, which is not as great as it may seem because ultimately, the stronger the labor market, the more likely the Federal Reserve is to drive up interest rates. And when interest rates are soaring, businesses are severely impacted, and so too are consumers, all of us. However, there is not much else that we can actually do as the Federal Reserve is looking to drive inflation down to 2%, which has been proven to be a massive challenge, more than anticipated. But what you need to know is that the end of 2023 could get volatile as uncertainty mounts and the market as well as businesses are just pressurized into drastically cutting expenditures. In other words, just begin to prepare for an economic downturn.
No, God! No, God, please, no! No!
But don't time the market, just get invested into the right sectors or the right stocks for that matter to see through to greener pastures. With all of that said, let's get to our very first dividend stock of the day. We have H&R Block, ticker symbol HRB, which is an American tax preparation company with operations extending outside the United States and countries as close to Canada and as far as Australia. Now in total, H&R Block has over 12,000 retail tax offices, always staffed and ready for the big day, April 15th. But what happens when April is far behind us and say July, like right now? Well, investors year over year tend to forget about this gem of an industry leader, though business for H&R Block continues to boom as individuals and small businesses still need their services. However, this conundrum makes for an opportunity for us to jump in on H&R Block as its stock share price is trending downward, and we already see it down by almost 10%, coming in at a share price of $31.07 per share. Not to mention a dividend yield at 10.7. But now, as mentioned, what goes down in H&R Block's case tends to actually just bounce right back up in time, and we even have analysts with those same upside expectations coming up to a share price of $35 per share, which is why I am sure sure, we have insiders who are also buying up more shares worth of the company while they can, and best yet is actually this in-between period with H&R Block, because that dividend yield of theirs is coming in at 3.64%. And before we get to our second dividend stock, I would like to take a quick second to ask for your help in growing this channel by tapping on that thumbs up button for the YouTube algorithm. And now more importantly for yourself is just subscribing to the channel so you never miss a single video. Now, as for the second dividend stock, let's discuss United Parcel Service, or better known by their ticker UPS, which is of course the world's most dominant carrier for shipping and receiving, and only continues to lead by example when it comes to, say, all supply chain management. However, as investors, we must note that UPS will be suffering during times of economic uncertainties as consumers cut costs and reduce shipping expenditures, whereas businesses are ultimately looking to cut costs as well and do the exact same thing in reducing spending, resulting in a depreciating share price with UPS, as it's currently down trading for $179 per share, which is still up on the year but has more room to run to get to that peak of around $200 per share. Not to mention this PE ratio coming in at 14.9, and with more market volatility likely, I think we will only continue to see hedge funds score more shares worth of this logistics behemoth, while analysts see 7.2% worth of upside, coming in at an expected share price of $193.07 per share in due time. But until it climbs to that peak again, shareholders will ultimately be able to enjoy this UPS dividend coming in at a yield of 3.42%. Next up, let's pivot into the healthcare sector, as one particular healthcare gem is heavily discounted right now, and it's one that we can't pass up. We have Amgen, ticker symbol AMGN, which is a leading biopharmaceutical company that's delivering through on innovative therapeutics addressing some of the world's most serious illnesses. However, every now and then we see investors shifting gears and trying really to play the market instead of just sitting tight with treasures like Amgen. And this is a solid dividend stock we have here, as it's down 12% on the year, trading for just $225 per share with a PE ratio coming in at 15.3. Yet analysts remain optimistic for a recovery and soon. So we have the share price climbing back up to over $270 per share in due time. It's over 19% worth of upside. And of course, plenty of hedge funds are also loading up on shares worth of this industry-leading healthcare company. But the best news when it comes to Amgen is its dividend, as we're all here for it. We can await a rebound with Amgen, that share price climbing, as well as this dividend yield coming in at 3.62%. And as for this fourth dividend stock on today's list, we have one that I have been mentioning time and time again, but I'm here to mention it once more because I am very optimistic about this investment within the financial sector with T. Rowe Price, ticker symbol TROW, which is a global investment management firm offering anything from funds to advisory services to a wide array of clientele. And it has certainly seen a lot of ups and downs since its founding all the way back in 1937. Now, with T. Rowe Price, I can tell you now, and many analysts will tell you actually to stray away from this one, that T. Rowe Price will be back. But it's going to be some more pain before it actually recovers, because interest rate hikes will be rising. However, as an investor thinking longer term, this is a gold find, even though it has already begun to rise on the year with a share price currently sitting at $111 per share. There's still plenty of upside to come. With the vast majority of T. Rowe Price's assets invested in the NASDAQ, again, it's all going to take time. We have a PE ratio here coming in at 18.4, and we also have hedge funds that just continue to pour millions of dollars into T. Rowe Price. However, it's about this dividend yield that I am loving the most, as it's coming in way above the sector average at 4.3%. And last but not least, I want to top off today's list with Devon Energy, ticker symbol DVN, which is a leading energy company that's engaged in the exploration of hydrocarbon within the United States. But most importantly when it comes to Devon Energy is actually the fact that Devon Energy has come a long way over the last few years from operational excellence to having low-risk production assets. But Devon Energy rather recently has actually been trading downwards, coming in at a share price of just $48.50 per share, which is almost 14% worth of a decline, with a PE ratio sitting at 5.3. Now, Now, to end on a positive note, analysts are actually just foreseeing upside with more than 30% worth of it on the way, with the share price climbing back over $63 per share. And smart money also is making more money moves into this position, but most enjoyable for us dividend investors is the Devon Energy dividend yield, as it's actually way above its sector average as well, coming in at 9.4%. And there you have it, investors, the 5 dividend stocks to add to your watch list right now. Now, don't think twice about your next move. Give this video right here a watch by simply clicking on it and going to reap more value from there. Now, also don't forget to tap on the thumbs up button and subscribe while you're at it to never miss a single video.